Started talking about accounting principles, and we primarily focused on ethics. And when we talked about ethics, there was three main things that we talked about that kind of fall under ethics, and that was confidentiality, conflict of interest, and integrity. And then yesterday, we focused on accounting process, and primarily talked about the accounting cycle for a sole proprietorship. Now, I didn't talk too specifically about the accounting cycle for a corporation, but you can see that same type of visual on page 504 of the textbook when you talk about accounting cycle for a corporation. But today what I want to do is focus a little bit more on journalizing and posting the closing entries, the process of doing that, and then also I want to talk about 4 different financial statements, one of which we did not cover during this class, so it's important that you guys understand what it is and what it communicates to its users, okay? All right, so closing entries, there are 4 primary closing entries that we're gonna make. And the first one is to close our revenue accounts. So all of our sales accounts, we wanna close our revenue accounts. And so our revenue accounts, AKA temporary accounts, also known as nominal accounts, show up on our income statement. And so at the end of the period, we need to reset them and set them back to 0. Revenue accounts have a normal credit balance, so in order to close them, we need to debit it. And the other part of that entry, double entry accounting, you have to have at least 2 accounts affected because your debits have to equal your credits. So we're closing the revenue accounts by debiting them, and the other part of that is going to be a credit to income summary. And then we're going to close all of our expense accounts. So we're going to close all of the expense accounts, and expense accounts have a normal debit balance. So in order to close them, we need to credit the expense accounts and debit income summary. All right, and so at this point, income summary is going to have a balance in it. If your revenue is greater than your expenses, that means you have net income, you're gonna wind up with a credit balance in the income summary account. If your revenue is less than your expenses, then you're gonna wind up, wait, did I say that backwards? All right, let's T account this out here. All right, so here's our income summary account, right? And when we close revenue, we're gonna debit revenue and credit the income summary. And then when we close expenses, we're going to credit expenses and debit income summary. All right, so if it winds up that our revenue is greater than our expenses and we have net income, we'll have a credit balance in the income summary account. If it winds up that our expenses are greater than our revenue, then we'll have net loss and we'll end up with a debit balance in the income summary account. So then our third step is then going to be to close the income summary account. Okay, so we're going to close the income summary account, and that is essentially going to either increase our equity or decrease our equity, depending on if we had net income or net loss from when we close these first 2 types of accounts. All right, so once we've closed the income summary and set it back to 0, our last thing that we're going to do is close in the terms of a sole proprietorship, close the drawing account, or in the terms of a corporation, close the dividend account. And we're going to close those accounts to capital or to retained earnings. And when we close income summary, we'll be closing income summary to capital or to retained earnings as well. So those are the steps in closing out our temporary accounts or our nominal accounts, which show up on our income statement, before we create our post-closing trial balance, which is just going to capture our permanent accounts. Okay, so it's only going to capture our assets, liabilities, and our equity accounts on our post-closing trial balance. Now I want to tell you about 4 different financial statements that we would have prepared. We would have prepared our income statement, and our income statement is going to show the profitability of the company during a period of time. Okay? The income statement is going to show profitability of a company over a period of time. We're going to have created our balance sheet. And our balance sheet is a snapshot in time, so it's just showing a moment in time, and it's going to show the financial strength of a company at that moment in time. So financial strength of a company during a moment of time is really based on, hey, do you have more liabilities than you do assets? Then your financial strength is poor. Are your assets greater than your liabilities, so you have some equity, then you have better financial strength. The third statement is a statement of cash flows. So the cash flow statement is something that we did not talk about in this class because it's in chapter 22, and I regret not continuing and finishing up those last couple of chapters, but you guys need to know about the statement of cash flows. So go ahead and look at page it's in chapter 22, it is page 692. So page 692, the statement of cash flows. Now, remember, the income statement shows the profitability of a company during a period of time. Balance sheet shows the financial strength of a company at a moment in time. And the cash flow statement shows a company's ability to generate revenue or generate cash. Shows a company's ability to generate cash. So the statement of cash flows, or the cash flow statement, is showing the company's ability to generate cash. Now, the statement of cash flows is going to be split into 3 different sections and basically going to show the inflows and outflows of cash during a period of time. So, you are going to split that into operating, investing, or financing. And on page 692, there's a chart there that summarizes all of the different ways that money flows into a company and all the different ways that money might flow out of a company, and how we would categorize that between operating, investing, and financing. Okay? So, let me ask you a question. If the majority of the inflows of your company are categorized as financing activities, is that a positive thing or a negative thing? Overall, if the majority of the money flowing into your company is through financing activities, would you consider that a positive or negative thing? Probably negative, right? If the majority of the inflow of money is coming either by taking out a loan or issuing new shares of stock in your organization, that's probably not a great sign. I mean, what it is a sign of is that people trust you enough to loan you money or to invest in you. But if that's the primary source of income or inflow of money for your company, that in the long run, that's not a good sign for operations. Remember that whole idea about financial leveraging? You want to make sure that you keep a healthy balance of how cash is coming into your business. All right, now operating income, that's the normal course of operation. So as you're buying and selling, your normal source of activity, that's going to be captured in the operating section of the statement of cash flows. The investment section of the statement of cash flows is going to deal with all of your sale and purchases of assets. Assets that help you do your operating activities, but you would put that in the investing section of your statement of cash flows. So statement of cash flows has 3 parts: operating, investing, and financing. And the point that the statement of cash flows communicates is the company's ability to generate cash. All right, and then finally, the last statement that you need to be familiar with is the statement of retained earnings, or the retained earnings statement, or the statement of stockholders' equity, or the retained earnings statement. Bro, I don't have another eraser. All right, and so the retained earnings statement is taking the equity section of your balance sheet and zooming in on the changes that occurred in the equity section of your balance sheet. all right? So when you're talking about issuing stock, or you're talking about sharing the wealth with the people that are owners of your company, all of that will be captured in detail on your statement of retained earnings. So, or your statement of stockholders' equity. So those are the 4 financial statements that I want you guys to be familiar with. Now, you guys need to pay a lot of attention to this one here because we didn't cover it in class. So it's not gonna come as naturally to you. So remember, that statement of cash flows is summarized on page 692 of the textbook. And so be sure that you spend some time looking at the statement of cash flows and understanding those different activities that fall into those categories on the statement of cash flows. All right, there's a quiz out there on Canvas for you to practice with. And so you've had one on Monday, Tuesday, and today. And then tomorrow we'll do one more activity similar to this, to where we'll talk specifically about ratios and financial analysis. So now that you have these statements, what would the users of these financial statements do with that information? Or what can you glean from that information, like gross profit margin and things of that nature? We'll talk about tomorrow. You'll have a little quiz with that. And then on Friday, I'm gonna give you guys a cumulative practice test that encompasses everything that we talked about this week, and hopefully preps you for the test we'll take next week on Monday and